Hey everyone, welcome back to the series of EIS scheme that we have been studying. The next topic which we will study is what are the relevant shares. Now, for the shares also to qualify, there are certain conditions. They must raise money for a qualifying trade. They must be ordinary shares, which means there should be no preference rights on these shares or no guaranteed dividends should be available on these shares, and they must be issued for genuine commercial reasons also, and not just for the purpose of tax avoidance. So basically, you invest in the same ordinary equity as the founders. So let's read it out here, that what are called as the relevant shares. The shares must be issued to raise company for a qualifying business activity, because we are trying to target the business growth and development of these companies. The shares must be ordinary shares, and they should not be carrying any preferential rights to the assets on winding up. For example, they should not be the preference shares. Then the shares must not carry any preferential rights on dividends, where the amount and timing of the dividend depends on a decision by the company. And the shares must be issued and subscribed for genuine commercial reasons and not for tax avoidance. So, what we are studying one by one is, first we studied that what type of companies are eligible. If you have not seen that video, please go and have a look at that. Then we are saying that company will issue some new shares. So what are the qualifying shares? And these shares will be issued to investors. So what are the conditions for the investors to be treated as qualifying investors? So now we will be studying qualifying investors here. Now, about the investor? You can't be connected with the company. That means 2 years before until 3 years after. You can't be an employee, neither can you be a close family. Now, close family will include your spouse, your civil partner, your parents, your children. Why? Because EIS is about bringing new external investment into the business. If you're already on the payroll, you shouldn't get extra tax perks by supporting your own company. That is the real logic behind this. So, to summarize, funding limits will keep the tax relief fair. The investor should be external and not connected. That is why we are trying to discuss that who is a qualifying investor. There are two important conditions for the investor to be, as far as the investor is concerned. First of all, in order to obtain the tax relief, the investor must not be connected with the company in the period beginning 2 years, means in the starting 2 years. Otherwise, it will be just the directors and the related parties who would come and invest in the company. 2 years prior to the issue of shares and ending 3 years after the issue of shares. Why ending 3 years? Because might be some person has invested for a huge amount and then he gets like a control in the company. So for 3 years after the issue of shares, this person should not be the connected person with the company. Broadly speaking, an investor is connected with an EIS company if they breach one of the two main conditions. The investor is connected with the company if they or an associate is an employee of the company. Then, and associates, first of all, the investor should not be the employee of the company. And it's not just, now the employees may come up with another solutions, that if I can't invest, then my associates can invest. Associates would include spouse, civil partners, ancestors, or descendants, which means parents and children. So your, if the employee is not eligible, then their related parties are also not eligible. That is a simple rule. Now, an employee includes a director as well. However, there are special provisions which allows a director of the company to be eligible for the EIS relief, and thereby to obtain income tax relief on subscription of shares. So we studied that investor cannot normally be an employee of the company. But since a director also counts as an employee, this would normally block the director from getting the EIS relief. Now, for this, the government recognizes the directors often as those persons who bring expertise and funding, which will help the small businesses grow. So, there are some special carve outs which we are going to study now. What are these carve outs? Number one, unpaid director. If the investor acts as an unpaid director, only he's getting the reimbursement of reasonable expenses or rent at a commercial level, which means at the arm's length price, then they can qualify, because this person is contributing the skill or time, but he's not taking any financial risk that makes them connected in HMRC's eyes. So this point is clear. Then they were not connected to the company before the share issue and they become a paid director after the share issue, but any remuneration they receive is reasonable. Then, the second provision enables investors who would like to make their business expertise available to the company in return for reasonable payment to become directors without this prejudicing entitlement to income tax relief. These investors are often referred to as business angels. So, what is the business angel rule? If the investor wasn't connected before, but after investing, he becomes a paid director with a reasonable remuneration, then relief is still available, because it will encourage experienced individuals, uh, which are the directors, and here we will call them as business angels. They will invest the capital and expertise while avoiding abuse, where directors just recycle the money into their own companies. So, but existing paid directors cannot qualify for EIS relief on new subscriptions. Similarly, if the director is an associate, the connection rules will also apply. So, here we read about this. Existing directors of the company who are paid remuneration for their services will not therefore receive the income tax relief. The above provisions also need to be considered where an associate of the investor is a director. Then, investor is also connected to the company if they hold more than 30% of the ordinary shares or they can exercise more than 30% of the voting rights. In considering whether the 30% limit has been breached, the shareholdings of the associates must also be taken into account. So, what is this exactly? This is the 30% connection rule. Relief will be blocked if the investor and their associates hold over 30% of the shares or voting rights of the company, because HMRC wants to ensure that EIS is used to attract genuine and external investors and not the controlling shareholders who are already benefiting from the company's success, right? Then then it is existing shareholders restriction also. Normally, if an individual already owns shares, they cannot claim EIS relief on the new ones. So, when we say the existing shareholder restriction, what do we mean by this? If you are already holding or owning the shares in a company, you cannot claim EIS relief when you buy more shares. Why? Because EIS is designed to encourage new investors to put money into the risky or growing companies and not just give extra tax breaks to the existing big shareholders. But again, there are two exceptions. What are these two exceptions? First, previous EIS, SEIS shares are held by these persons. If the shares already held were acquired as a part of an issue which qualified for income tax relief under EIS, SEIS, SITR provisions, or the shares, subscriber shares, which we call as the shares already held are subscriber shares, that is issued to the individual when companies are incorporated. So, what's the thinking behind this rule basically? It's very simple. HMRC doesn't want existing investors with a big stake to use EIS just as a tax saving tool, but at the same time, they still want to encourage early supporters like founders with subscriber shares or genuine EIS or SEIS backers to keep investing in the business. So, this was all about which investors would be called as the qualifying investors, what are the relevant shares, then what companies are called as the qualifying companies, and in the beginning we studied about carryback of relief and what is the limit of tax relief that would be available on the EIS shares. Now, then we are left with just two more topics regarding EIS, and then we will start about SEIS, which is almost same as EIS, but some new points we will be covering. Thank you.